In this session, we'll move on to one of the important concepts in financial management, that is present value. How to find out the present value? What is present value? Okay, that's what we are going to understand. Let's say I have 1000 rupees now. I'm going to invest this 1000 rupees at the rate of 10% for a period of 1 year. It means this 1000 will get added by this 100 and it will reach a value as 1100 in future, that is 1 year by now, and that 1100 we call as future value. Okay, now understand one thing, this 1000 has become 1100 and so we call it as future value of 1000. Then if you look at it from that 1100's point of view, we can say this 1000 is present value of 1100. Okay, so understand, 1100 is future value of 1000, whereas 1000 is present value of 1100. What I am trying to communicate here is, if you are going to pay 1100 in future, or let's say you are going to receive 1100 in future, it is equivalent to having 1000 now. Okay, that's it.
What is market value? Market value or market price refers to the price that purchasers and sellers both accept. In other words, the price at which they agree to trade a product or security in an open market. Put simply, market value is the amount for which something can be sold in a given market. The market value of a company depends on two things. 1. How many outstanding shares there are, and 2. The value of each share. We multiply the total number of shares by the value of each one. The total is the company's market capitalization. People calculate a company's market value for many reasons. Perhaps they need to raise additional capital, proceed with a merger or acquisition, or motivate management. We also calculate a company's market value before listing it on the stock exchange, a divestiture, or for taxation purposes. Determining the market value of exchange-traded instruments such as futures and stocks is easy. It is easy because their prices are easily available. It is more difficult, however, to accurately establish market values of over-the-counter instruments such as fixed-income securities. Some assets are particularly difficult to value. Illiquid assets such as businesses and real estate have market values that are challenging to determine. Investors usually have to consult real estate appraisers and business valuation experts. Illiquid assets are those that cannot be turned into cash rapidly. Thank you for watching this brief market business news video on market value.
So let's talk about the financial assets first. IAS 39 classifies financial assets into four main categories. Financial assets at fair value through profit or loss. These are financial assets that are either classified as held for trading, or upon initial recognition they are designated by the entity as at fair value through profit or loss. All derivatives fall into this category. The second category is held to maturity financial investments. These are non-derivative financial assets with fixed or determinable payments and fixed maturity that an entity has the positive intention to hold to maturity, but other than those designated at fair value through profit or loss upon initial recognition, or other than those designated as available for sale and those that meet the definition of loans and receivables. The third category is loans and receivables. Those are non-derivative financial assets with fixed or determinable payments that are not quoted in an active market, other than those that entity intends to sell immediately or in the near term. These would be held for trading. Other than those designated at fair value through profit or loss upon initial recognition. Other than those designated as available for sale, and other than those for which the holder may not recover substantially all of its investment other than because of credit deterioration. The last or fourth category is available for sale financial assets. These are non-derivative financial assets designated as available for sale, or financial assets that are not classified in either of the three previous categories. Initial classification of financial assets is very important for their initial and subsequent measurement, as well as for recognition of gains or losses. Initial measurement means simply the amount in what the financial asset is recognized in the financial statements at its acquisition. Standard IAS 39 requires to measure financial assets at fair value through profit or loss at fair value, and for other assets at fair value including transaction costs. Subsequent measurement means simply speaking the amount in what the financial asset is carried in the financial statements after its recognition, for example in the second, third year, and so on. Financial assets at fair value through profit or loss shall be remeasured to their fair value. Held to maturity financial investments and loans and receivables shall be carried at amortized cost using the effective interest method. And available for sale financial assets shall be remeasured to their fair value too. The exception here are investments to equity instruments like shares that have no reliable fair value measurement. In this case, they shall be carried at cost. IAS 39 also prescribes how to account for gains or losses from subsequent measurement of financial assets. For the first three categories, you shall put gains or losses from remeasurement of financial assets to profit or loss. For available for sale financial assets, gains or losses shall be recognized to other comprehensive income. Then at derecognition, for gain or loss from other comprehensive income shall be taken to profit or loss. This is known as recycling. Of course, impairment of these assets shall be put straight to profit or loss. Referring to financial liabilities, things are a bit less complicated here. IAS 39 basically classifies financial liabilities into two categories. Financial liabilities at fair value through profit or loss. These are financial liabilities either classified as held for trading or upon initial recognition designated by the entity as at fair value through profit or loss. The second category are other financial liabilities measured at amortized cost using the effective interest method. Initial measurement of financial liabilities at fair value through profit or loss shall be at fair value, and other financial liabilities shall be measured initially at fair value including transaction costs. With regard to subsequent measurement, financial liabilities at fair value through profit or loss shall be measured at fair value, and other liabilities at amortized cost using the effective interest method. Gains or losses from remeasurement of financial liabilities shall be recognized to profit or loss.